Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market looks like this. Down just a touch, down 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Black Friday shopping setting an online record, pressure growing on Israel to extend the ceasefire, and Argentina's Milei touching down in Washington. From New York, we begin with the big issue, the U.S. consumer holding on.
The consumer's been incredibly resilient.
The consumer has money.
The consumer is managing things.
The positives for consumer spending outweigh the negatives right now.
The household balance sheets, we view, is still very strong and will continue to be strong.
Household wealth is up.
Given where real wage growth is,
The strong labor market.
probably the consumer is going to be in rude health.
Retailers will continue to benefit from rising consumer spending.
And we think that that continues.
We're going to see some strength.
Overall holiday sales are expected to be up.
We're going to see a decent holiday
You
season.
can get through this holiday season with somewhat of a decent gain.
We're still in the soft landing camp.
I have learned not to bet against the American consumer.
Let's have that conversation right now. Joining us to discuss, Schwab's Colin Martin, Sumit Samana of Wells Fargo. Colin, straight to you. How much juice is left in this U.S. consumer?
No, we don't think there's that much left. Obviously, if you look at the numbers, the consumer has been very resilient. You hear all the comments from those past guests, and the consumer's holding up really well. But if you look closely at the numbers, we're still seeing consumer credit continue to rise. I think that's interesting when you kind of compare that to the idea of all the excess pandemic savings are in there and how much is getting whittled down. If there is, in fact, a lot of excess savings still, with the consumer and on those household balance sheets, we wouldn't really see a pickup in consumer credit the way we have. And we have seen consumer credit continue to grow in an environment where borrowing costs just continue to rise. So it's been good for now. We hope it continues. That's obviously a good thing, but we're not convinced that it can continue at the pace we've seen lately. I think a lot of it does come down to consumer confidence. Even though we're seeing strong consumer spending, we're seeing consumer confidence come down. At some point, the high level of prices will have its toll. We look at it as inflation coming down, and we kind of applaud that. But I think the way consumers see it, they just see an absolute level of prices that are still very high. So I think we might see some strong sales through the holiday season, but as this continues into 2024, I think it really is going to start to weigh on the consumer and the economy as a whole.
We've heard that call a lot through this year and into next year. Samir, there is so much conflicting information. If you look at the guidance we have from corporate America, the retailers, they're telling you slowdown is coming, then jobless claims, boom, super low, 209. Samir, what are you following? What do you put more weight on, the guidance or the data?
Well, I guess what I'll say is, look, if the consumer remains resilient, then it's pretty clear to us. The Fed is probably going to start to fire up the rate hiking cycle once again, because you just cannot get inflation down with the consumer feeling this good and being this resilient. So I guess for us, it's more about markets. It's more about if the consumer stays this way, then the Fed just cannot get inflation back down to their 2% target. So I think the real key now is, does the consumer slow down, to your point? Or if they stay resilient, then the Fed or the long end now has to get involved. And I don't think rates can stay down here at 4.5 on the long end if the consumer is going to keep on spending.
Either way, your call seems to be slow down, Samir. I'm going through some of your calls at the moment. Recession early 24, earnings stumble just ahead, limited upside. I think unlikely that we get a meaningful move to the upside is your call. Samir, what's behind that?
Yeah, I mean, it's exactly that. It's the fact that we do think the consumer will slow down. Consumer spending is always the most lagging of all indicators, along with unemployment. So I appreciate that people are looking at that and saying, look how resilient things are, look how low initial jobless claims are. But we all know that they're going to, kind of be one of those nonlinear factors where they're kind of, muddling along, and all of a sudden there's going to be a huge spike, and all of a sudden we're going to worry about recession. And so we'd rather try and get ahead of that as opposed to wait for it to happen.
Hey, Colin, there are so many calls for next year. The one that jumps out for me this morning is from Deutsche Bank. Deutsche Bank is calling for a recession early 2024. And Colin, on top of that, they're calling for 175 basis points of cuts. Colin, how difficult is it to make a forecast like that with unemployment south of 4% and jobless claims still in at around 200K?
I think it's pretty difficult. We're not in that camp. We do think things should slow down, but in the here and now, the economy is moving along, and that's a good thing. We obviously don't want the economy to slow. We don't want the economy to go in recession. We do think a recession will happen at some point down the road, but early 2024 just seems a bit early right now. If you're looking at an unemployment rate that's still under 4%, even though it's been rising, we're still seeing a resilient consumer as we've discussed this morning. So we think that is a little early, but we are worried that things will slow down. We don't think this kind of Goldilocks scenario will continue. A soft landing will be great, but if it were to occur, but we still look at past relationships, and we know that when the Fed tightens, things tend to break. If things don't slow down enough, if inflation stalls or even worse, reaccelerates, I think the Fed could act. That's not our base case, but I don't think the Fed would be slow to react if that were to happen. And we think the Fed will do what's needed to get inflation convincingly down towards its target, whether that means more hikes or just holding at its peak for longer than the markets expect. But we do think over time that those lagged impact of monetary policy are still there. And we're starting to see the cracks, but we think that'll continue in 2024.
One thing that isn't breaking at the moment, or even cracking, is consumer spending online. Katie Crawford has the story. Morning, Katie.
Yeah, online shoppers showed up in a big way on Black Friday, spending a record $9.8 billion. That is a 7.5% increase compared to last year. This is according to Adobe Analytics, and it was really driven by demand for electronics, smartwatches, TVs, etc. Now, there had been a lot of question marks heading into Black Friday about consumer resilience, given that you do have high inflation, dwindling savings, which may help explain why you saw buy now, pay later spending rise 72% from the prior week. But all in all, Black Friday definitely a needed win for retailers. That 7.5% increase was ahead of Adobe's forecast for a 5.7% jump. Could bode well for Cyber Monday today, where Adobe sees a 7.1% increase versus last year. And the analytics firm said this morning that it expects consumers to spend between $12 and $12.4 billion today. That would be a record, and buy now, pay later spend expected to surge nearly 19% compared to last Cyber Monday. And as you would imagine, great news for e-commerce names, especially for Canada-based Shopify. Shares currently up about 3% pre-market after it said that global Black Friday sales rose 22%, John. So we'll see how Cyber Monday goes.
Katie, thank you. Cyber Monday is still a thing, even though we had all that online shopping on Friday, apparently. More on Shopify around the open about price targets. So that's some good news. Let's talk about price targets. 5,100 at the high end from Deutsche Bank's Binky Chowder. In the mix, in the middle, Goldman Sachs, 4,700, looking for limited upside. Stick on this just for a moment. Bear with me. Deutsche Bank's talking about recession. They're talking about 175 basis points of cuts. And they're also talking about all-time highs of 5,100 by year-end next year. Goldman Sachs is talking about a continuation of the cycle, tailwinds for economic growth, a Fed that stays on hold. And then on the equity side, they're talking about 4,700 on the S&P. Samir Samar, I want your view on this. Make sense of this for me. Is good news bad news next year? And is bad news good news?
So I think what most people are looking at is the fact that corporate America has done a very good job of managing costs and keeping those earnings at a higher level. And so once you get those earnings kind of in that 230, 240 ballpark, which is really where most people are on the street, we're at 220. It's hard not to put kind of a high teens, low 20s type of multiple on it. So everybody kind of falls into this mid fours to high fours type of price target. I think we're all somewhat hopeful, and I think hope does have to be a part of this, is that the recession comes sooner rather than later. If the recession is pushed off, or if it's avoided altogether, I think you're going to have long rates especially go much, much higher. And then the eventual landing will be much harder than I think most folks in the markets want. So I think that's the tricky part, is I think a lot of people are thinking that the recession comes earlier next year. If it doesn't, then I think a lot of those numbers will get marked down.
So, you've said this twice now. Long rates are going higher. In fact, just a moment ago, you said much, much higher. The 30-year at the moment is 460. We've seen 5%. We backed away. The 10-year right now is 445. We saw 5%. We backed away. When you say much, much higher, Samir, what kind of numbers are you thinking about?
I mean, our target for next year is 5%, but it would not surprise us if between now and then you actually kind of got up to maybe the high fives, maybe even possibly saw a 6 number. Again, coming back to just how resilient things are, if the Fed's going to stay on hold, then the long end has to do much of the work for them.
Samir, 6%. Is that actually the base case for you?
It's not a base case for us, but it would not surprise us because, again, right now, if the Fed's going to stay on hold, then some part of the market has to do the heavy lifting. And if it's not going to be the Fed, it's got to be that long end.
Colin, what's the counterpoint to that?
Well, we think 6% would be very surprising. 5% over the next few months, we could see it, but that's not our base case. We do think that the long end should continue to trend low over the next few months. If we look at the 10-year, we think the 4 to 4.25% range is a good landing point, again, over the next few months, based on our expectation that the next move by the Fed should be a cut. And that should pull the whole yield curve down, maybe not necessarily in parallel fashion, but it should bring all yields a little bit lower. To get yields significantly higher, we think we need to see a sharp reacceleration in inflation. Again, not our base case, and that, as Samir mentioned, would lead to a bout face by the Fed, but we just don't see that happening. Given everything we're seeing, if we see inflation trend lower, we're seeing growth a little bit resilient, that is the soft landing, which it appears to be getting closer and closer, and that can just result in a few rate cuts if necessary next year, more based on the level of inflation and less based on the need to stimulate, because the more inflation comes down, if that trend continues, makes real rates more and more restrictive. So I think that's more of the reason why we'll see a few rate cuts next year versus a sharp recession early in the year and the need to stimulate.
We've got a lot to discuss. We'll continue this conversation. Colin Martin, Samir Samana sticking with us. Your equity market, about 20 minutes out from the opening bell, slightly softer, negative here by 0.2%. Quite a run coming into this week. 4 weeks of gains on the S&P 500, longest weekly winning streak going back to June of this year. Let's get you some movers going into the open. Let's say good morning to Abby. Morning, Abby.
Good morning, John. And despite the fact that we do have futures modestly softer, let's start off with two gainers. It's not just Shopify that's booming after record Black Friday online. We also have Amazon trading higher by about 0.8%. In addition, a headline dropped just minutes ago talking about the idea that Salesforce is listing their software on the AWS marketplace. Carnival had been much higher earlier, up closer to 1%, now up 0.2%. This is Melius. Boosts the company to a buy on the tailwinds of solid demand and fuel costs down. To the downside, though, Coinbase down 2.3% in sympathy with Bitcoin. But CEO Brian Armstrong recently said in an interview that the crypto industry can move forward with the Binance settlement. Well, today, the crypto industry seems to be held back to some degree, again, by Bitcoin and some of the other cryptocurrencies lower to the downside.
Abby, thank you. More from Abby around the opening bell. Coming up on this program, Israel under pressure to extend the ceasefire.
Critically needed aid is going in and hostages are coming out. And this deal is structured so that it can be extended, to keep building on these results. That's my goal. That's our goal, to keep this pause going beyond tomorrow.
That 4-day truce ending tomorrow morning. The latest on the Israel-Hamas war. Up next.
Critically needed aid is going in and hostages are coming out. And this deal is structured so that it can be extended, to keep building on these results. That's my goal. That's our goal, to keep this pause going beyond tomorrow so that we can continue to see more hostages come out and surge more humanitarian relief into those in need in Gaza.
Israel under growing pressure to extend its 4-day ceasefire with Hamas ahead of Tuesday's deadline. The pause leading to the release of 58 hostages throughout the weekend. Israeli Prime Minister Benjamin Netanyahu writing this. There's an outline that says it's possible to release an additional 10 hostages each day. That would be welcomed. Hamas also saying it wants a longer pause without specifying whether it would free more hostages. Bloomberg's Katie Lyons joins us now. Morning, Kaylee.
Good morning, John. Well, there is a question of Hamas's ability to release more hostages, keeping in mind that it is not actually holding them all. Our understanding is there are a number of different groups who are holding these hostages. So some of this will depend on their ability to actually get them in order to release them. That said, they are working against a deadline here, knowing that this 4-day deal, which began early morning Friday, will expire early morning local time tomorrow. And of course, there is a push now really internationally, including from President Biden, to extend this pause for longer. While the administration's position is still that they do not support an outright ceasefire, they do support the temporary extension of this one. It is not just to get more hostages out, as we were just hearing from the president. It also is about getting more aid in. The difficulty is the longer this pause is extended in the eyes of some Israeli officials, the more opportunity it leaves Hamas to rebuild and regroup potentially. And when Israel does resume the fighting, which Prime Minister Benjamin Netanyahu has said they will do whenever this pause expires, that they will continue fighting until Hamas is eliminated, it may make that fight more hard. And of course, it is harder for the Biden administration politically here domestically. The longer the situation is ongoing, you are seeing pushback from many progressive lawmakers in the Democratic Party on Capitol Hill. And keep in mind, John, Congress is returning after their Thanksgiving break to Washington this week. Israel aid has passed the House. It's dead on arrival in the Senate. There's going to be a wide conversation about how to get more funding through. And there's calls now from the White House to actually have any further aid contingent on more humanitarian compliance with international law, given the growing death toll of civilian Palestinians in Gaza, John.
Well, Kelly, let's get into this. How much daylight is there? And we've been asking this all morning. How much daylight is there between what the president is willing to support and what his own party will support?
Well, it's getting much harder. This president has been very supportive of Israel, John. He has essentially said the support for Israel on the part of the U.S. is unconditional, and they have been supplying military aid. But he has requested billions of dollars in emergency funding from Congress. They are going to have to be the ones that ultimately actually pass it and deliver it to Israel. And that is becoming a more complicated situation in some progressive parts of the party. Though by and large, John, there is still bipartisan support for Israel. It's just the longer this conflict goes on, there are growing calls for more humanitarian considerations to be had here.
You'd have to imagine, you mentioned the aid to Israel, Kayleigh, beyond what they might tie to that aid, there's going to be the mother of all fights next year over spending. Can you go through just how big that fight's going to be?
It's going to be massive, John. There is a conservative wing in the Republican Party in the House that would like to see deep spending cuts. The issue is whatever passes in the House has to be reconciled with the Senate and signed by a Democratic president. And there is a lot of daylight on the subject of daylight between those two in terms of the spending levels they would like to see. Keep in mind, we're dealing with two different deadlines here. January 19th for part of the government, including Veterans Affairs, for example, and February 2nd for everything else. And a lot of the people I speak with here in Washington think that it's very likely a shutdown, at least a partial shutdown, may happen in January as they try to work out all of these appropriations measures. And knowing that the current Speaker, Mike Johnson, has said he would not support another temporary extension in funding, that means they're going to have to actually get a budget done. And knowing we're up against the Christmas break here, there's not that much time to do so, John.
This is not going to be fun, that's for sure. Kelly, thank you. Great work as always down in Washington, D.C. Colin Martin, Samir Samana back with us. Samir, let's frame out early 2024. Just how bad is that fight over spending going to be? And what are you telling clients about what it could mean for this market?
Yeah, I mean, look, it's just going to be very difficult no matter who's the Speaker of the House in order to kind of wrangle all the Republicans and get the government to kind of keep functioning. So I think that's going to be a big thing for us to watch. It would not surprise us if at some point there is a shutdown, just because, again, it seems like those on the right really do want to kind of have that as maybe kind of a principled fight. What we're telling folks, really kind of big picture is, again, we expect a recession. We expect it in the early part of next year. We think here at 4,600, the market is pretty fairly valued. Our target for next year is 4,700. So a lot of those gains have been pulled forward. We think rates end the year next year at 5%. So even those seem a little bit low here to us. So I think, the first part of next year, even though the seasonals are pretty favorable, we think will be kind of a muddle through a year. Again, could you have a little bit of an overshoot here to 46, maybe 4,700? It's possible, but we would take advantage of that to get the portfolio looking the way you want going into a recession, right? So that means going into larger cap, higher quality U.S. equities, especially those in the industrials, materials, and healthcare sectors. And then you want to avoid small caps, you want to avoid emerging markets, and you want to avoid the consumer discretionary and real estate sectors. That's the right portfolio going into a recession for us.
Samir, unpack what you just said, though, and what it could mean for this budget deficit. You've got recession on the one hand, but you've still got a 5% call on a US 10-year. And this week alone, look, we can't get used to these numbers. They're massive. This week alone, $55 billion of 5-year notes coming to market today. Tomorrow, $39 billion of 7-year notes. Given the financing needs, Samir, of this government in Washington, given the call that you've got for recession, yet still you think 5% on 10-year rates, just how big are these interest costs going to be as a percentage of income and revenue?
I mean, that's just it, right? They're slowly eating the budget. We need some type of longer-term fiscal solution, right? The path we're on is not sustainable, right? If you're going to have defense spending, if you're going to have title spending, and you're going to have interest rates where they are, it just doesn't add up, right? So at some point, there's going to be some very difficult decisions made. And to your point, it's not sustainable, which is why even in a recession, we don't see rates falling all that much because, again, you have kind of that longer term to account for.
Colin, can you tell me why, given everything Samir's just said, this bond market's still a buy?
We still think it's a buy because we just don't see that much upside. We don't see yields moving significantly higher from here. I mean, they could retest 5% again, but that's not our base case. One thing I will focus on is the whole budget deficit treasury supply situation. We get that question a lot from clients, and there's a lot of investors out there that are concerned that the huge deficit and the fiscal path we're on and the supply that's accompanied that will lead to a sustainable rise in treasury yields. And we just don't think that's the case. It might lead to volatility here and there around specific treasury auctions. But over time, if you look at the relationship between budget deficits, between the amount of debt outstanding, between the rise or fall in treasury supply, there just hasn't been much of a relationship. Now, that doesn't mean we are endorsing the fiscal path we're on right now. We're just stating that over time, it doesn't matter too much in terms of the level of treasury yields. We think it's based more on growth and inflation expectations and therefore Fed policy. And as we've discussed so far this morning, John, we think treasury yields will trend a little bit lower from here. And whether the 10-year treasury yield is 4, 4.5, or 5%, we think that's attractive for a lot of investors out there who have been waiting for these yields. And I think if you're an individual investor, and that's our main client base here at Schwab, usually there's some sort of investment return bogey that you have to help you meet your goals. And we're seeing yields that are at these levels that are letting you de-risk from other areas and letting bonds do more of the heavy lifting than stocks might have had to do historically. So we think it's really attractive, even though there's likely to be volatility, but just accept and be happy with those yields that we're seeing now, because we think over time they should fall. And if you wait too long, you might not have the opportunity that you have right now.
Two similar calls on the economy, two very different calls on this bond market. Colin Martin, Samir Samana, to the two of you. Thanks for being with us. Coming up on this programme, the morning calls, and later, Deutsche Bank calling for record highs next year. That conversation still ahead with Morgan Stanley's Caterina Simonetti. Your opening bell about 7 minutes away. A little two-day winning streak coming into this week on the S&P 500. Equity futures pulling back this Monday morning just a bit. We're down around about 0.2%. That's the price action. Let's get you some morning calls. First up, Needham downgrading Lucid to hold, pointing to weakening near-term demand. Your second call from UBS upgrading Mondelez to outperform, $83 price target, highlighting its best-in-class growth profile. And finally, Citi downgrading Foot Locker to sell, expecting weaker than estimated Q3 results. Coming on Wednesday, the stock is down 3.6%. Coming up, Morgan Stanley's Caterina Simonetti on the road to nowhere for the S&P 500. That conversation coming up shortly. Futures a little softer. Your opening bell just around the corner. Okay, let's get your trading week started. Live from New York City this morning. Good morning to you all. Your equity market on the S&P 500, 4-week winning streak, longest weekly winning streak going back to June of this year. Equity futures at the moment pulling in down lower, negative by about 0.1% on the S&P. On the Nasdaq 100, what a run month to date. We're negative here by, let's call it 0.2%. There's your opening bell in New York. Switch out the board and get to the bond market. Yields look like this. Down a couple of basis points on the session. Up a few basis points last week. Last week, interesting. I know a holiday shortened trading week, but jobless claims caught my eye. I know it caught yours too. 209K on claims. Yields a little bit higher off the back of that. 2 weeks away, by the way, from payrolls. A couple of Fridays away. Sneak peek of payrolls next week. 188 is the estimate in our survey at the moment. Your 10-year, 4.44. In the FX market, the euro been showing some strength over the last few weeks. 109.32 at the moment, showing some weakness against the dollar. Just a touch on that currency pair, negative by 0.06%. And crude, 75. We're down about 20 cents to $75.35. We're negative by 0.25%. About 40 seconds into the session, we're going absolutely nowhere on the S&P 500, almost dead flat on the Nasdaq. Let's get you some movers. Shopify, merchants setting a record Black Friday. Abigail Doolittle has more. Hey, Abby.
Hey, John, and this is impressive. The stock is up about 3% into today, already a double, up 102% on the year. So adding to those gains, the best day in about 2 weeks after the company did say that its merchants set a record in sales for Black Friday, $4.1 billion. Now, it's interesting. I don't know exactly how we square this with Adobe Analytics, which said that the overall number for Black Friday is $9.8 billion. If it's apples to apples, Shopify's merchants are they're close to 50% of that total, which is really pretty impressive. They, of course, help small businesses build their online websites. They also provide other merchant services. Analysts are very positive, too. The company's very positive. The Shopify president, Harley Finkelstein, saying the world showed up for our merchants, and the excitement is only building with Cyber Monday still to come. That is, of course, today. Analysts agree that they're very positive on Shopify's results on Black Friday, thinking that the growth would continue through Sunday. One analyst saying mid-high teens growth right through Sunday. But we also have Jeffrey saying that they're positive on Shopify right now. Very good trends, clearly, but they want to see how Cyber Monday goes. So time to start shopping, John.
The stock is up by 2%. I'll do my bit, Abby. No doubt about it. Let's turn to this news. Elon Musk in damage control mode, meeting top Israeli politicians due to growing criticism of anti-Semitism on X. Ed Dudlow has more. Morning, Ed.
Yeah, good morning, Jonathan. In a Spaces on X, the platform formerly known as Twitter, that lasted around 20 minutes, Musk and Israeli Prime Minister Benjamin Netanyahu discussed the Israel-Hamas war. Musk said that he'd like to help rebuild Gaza after the war's conclusion. He also said it was troubling to see protests in favor of Hamas. The origin of the pressure on Musk is a post that he made earlier this month, which was seen as endorsing an anti-Semitic theory by another user. That did not come up during the Spaces, and indeed, Benjamin Netanyahu did not challenge Musk on it. Musk will have a series of meetings while he is there in Israel. He's already visited the site, or the principal site, of the October 7th Hamas attacks. He will meet with Cabinet Minister Benny Gantz and President Isaac Herzog. He's also due to meet with leaders from Israel's technology sector. One that we'll be watching closely, John, is Starlink. There are talks between the Israeli government and SpaceX on activating Starlink coverage in the country. Remember that when the Israel-Hamas war first started, Musk talked on X about the idea that they would activate or operationalize Starlink in the Gaza Strip. He then walked those comments back. So that is an area of focus for both sides, and the Israelis are kind of hinting that it's a deal that's close to being done.
Ed, just a follow-up question for you. There's been great debate about how justified this criticism of Elon Musk has been over this platform over the last month and the last year, for that matter. Yeah. Ed, has it affected Tesla in any way, shape or form when you see day-to-day price action off the back of stories like this?
It has not affected Tesla, and it's impossible to draw a causal link, though, you know, people that I speak to in the investor base and internally say there isn't a causal link here. You know, Musk has stated pretty clearly on the X platform he is not anti-Semitic. He basically, you know, labeled media coverage of that post, which was seen as endorsing another user's anti-Semitic theory, as bogus, and has defended that position. And indeed, you know, I've spoken to some pretty senior people within Tesla, some of them are Jewish themselves, that give the opinion that this reaction to Musk is overdone. However, he is now in Israel meeting with the country's leadership, and so has been pushed to do something. And, you know, the conversation I had over the weekend, pretty telling when this news came out that he would make the trip there and his reasons for doing so.
Ed, thank you, sir. Thanks for the update. We'll catch up, no doubt, a little bit later on. I want to turn to this. A disappointing weekend for Disney. Its newest animated film, Wish, placing third at the box office. Katie Greifeld has more. Hey, Katie.
All told, Wish brought in just under $20 million over that three-day weekend. This is according to ComScore. Now, that puts it behind The Hunger Games, The Ballad of Songbirds and Snakes, as well as Apple's Napoleon film, which of course is a bit of a blow for Disney for a couple of reasons here. The first being that Disney CEO Bob Iger, he actually said earlier this month that the Walt Disney Animation Studio is one of the building blocks for Disney's future and that he will personally be involved in that effort. So clearly some wood to chop there. Second being that Disney has been dominant over the Thanksgiving period in years prior. Remember Frozen 2 in 2019, huge. Then you had Encanto in 2022, and then Black Panther, Wakanda Forever just last year. All big hits at the box office. So of course, Wish it did have some tough comps here. It couldn't quite meet that bar. You take a look at Disney shares this morning, currently down about 1%, John.
Garbage movie, Katie, absolutely.
Wish?
Yeah, garbage movie.
Jeez.
Seriously, it starts out by something that I think roughly looks like some form of socialism, communism.
I don't know if you're the
audience. Where you sort of outsource
but...
your dreams to this king who has power over us all. Socialism, communism, and he provides you security. And then later on in the movie, it kind of finishes with central planning. We can talk more about that a little bit later. My thoughts on Wish over the weekend with a 4-year-old nephew. About 6 minutes into this session, I loved it every second. Equities on the S&P negative by 1/3 on the Nasdaq. We're down about 1/3 as well. Just finally, we're also watching shares of Crown Castle. Activist investor Elliott Management reviving calls for leadership changes after disclosing a roughly $2 billion stake in the tower operator. Simone has more. Hey, Simone.
Hey, John. Yeah, that's out of a company market value of about $47 billion. Elliott calling its activist campaign restoring the castle. Crown Castle, it's worth noting, is a REIT that owns wireless towers, other wireless infrastructure. It rents out those towers to T-Mobile, AT&T, and Verizon. Elliott, in its letter this morning, talking about wanting to install new management and board leadership, conducting a review of a $19 billion fiber business, optimizing the company's incentive plan, and improving on corporate governance. And it said this, I quote, "The company's strategy led by CEO Jay Brown since 2016 has been a failure as demonstrated by the breathtaking magnitude of its underperformance." Now, as you alluded to, it's not the first time Elliott has held a stake in this company. It had previously sought changes back in 2020, especially to the fiber strategy. The company did not move forward with those. Shares then hit a high in January 2022, but they've about halved since then. They're down over 20% year to date. And it seems like we should be on the lookout for more news, especially early next year when it is expected that Elliott will nominate a new board slate, John.
Simone, thank you. Appreciate the update. Crown Castle there, just slightly positive. I want to turn to Morgan Stanley's outlook. Caterina Simonetti looking ahead to next year, writing this. While 2023 has been very good for the S&P 500, it has been challenging for many stocks. This is not indicative of a healthy bull market and will most likely persist into early 2024 before a sustainable earnings recovery takes hold. Caterina, I'm pleased to say, joined us right now. Caterina, on the S&P 500, let's go through it together. About 8 minutes into the session, the S&P is at 4550. So we need to talk to you about the road to nowhere. What do you see, basically no upside, Caterina, on stocks, at the index level at least, going through next year?
Well, Jonathan, thank you for having me on the show. We're going nowhere, but we're getting there fast. And when you look at the S&P 500 for the duration of this year, it's been driven by 7 big names. And it's important to be said that it was a well-deserved, drive that these 7 magnificent stocks performed well because of their competitive positioning and the price and, the positive earnings revisions, which we have not seen, in other sectors. But we cannot forget that actually 7 out of 11 sectors were down for the year, which is extremely challenging for investors because it is shaking their core belief in diversification, in dividend investing, in things that generally work. But what we tell investors is that, of course, the market leadership is cyclical, and that the names that performed this year might not be the names that will perform well next year. And we've seen earnings revisions all across the board, which means that even though we might see a lot of volatility, might take some time, but we should see some earnings recovery at some point next year. And we're actually positive for 2024. We just think that it's going to be a reasonable amount of growth, nothing too exciting. And all of that, considering that the data is going to support some type of rate cuts by the Fed.
Well, let's talk about how you're looking to barbell the hopes and dreams of next year, maybe been better than expected with that defensive pose, tactically speaking, that you seem to have right now, that defensive posture. The consumer, discretionary or staples, Caterina, for you, going into next year?
Jonathan, absolutely staples, no question about it. We actually think that there are some very attractive valuations in value in dividend stocks. We advocate the barbell between the defensive stocks and energy, financials, and industrials. And the sectors and the equities that might have not been best performers this year because of the earnings revisions and because they are revising and kind of positioning themselves for success, we think that might be the areas that will drive the market. And most importantly, in light of the volatility, it will provide a little bit of that safe haven for investors that are looking for a more slow and steady type of return and a little bit less of the roller coaster ride.
Katerina, you like staples, but you also like energy. Can you reconcile those two views into next year?
Well, Jonathan, we cannot ignore the geopolitical risks, especially right now. And as we look at the energy as a whole, one of the most unusual things that we've seen earlier this fall is the fact that energy has been high and the US dollar is high. And when we look at the possibility of what has to happen in the world for the energy prices to go down, that seems highly unlikely. We think that production is not going to be increased, and therefore energy prices most likely are going to stay high, considering the demand and considering the production overall.
That's the equity picture. You mentioned something earlier in the conversation, which I think has got to be a big part of the conversation with investors, your clients, into next year. How their faith in diversified portfolios has been shaken by just how positively correlated everything has been. Where are you finding that uncorrelated diversification for next year and beyond in the market regime that's dominated the last 12 months?
Well, remember, Jonathan, it's not about a month or a quarter or even a year. It's about the large picture. And the concept of diversification, tells us this: we should not be chasing high performers. We shouldn't be buying the stock just because it is high. In fact, we should be doing the opposite. We should be looking for values. We should be looking for companies that are competitively positioned, that have high operational efficiency, that have cost advantage, and that position themselves through the earnings revision and cost cutting competitively going forward. That's number one. Two is, this is a wonderful opportunity for some of the tax management and doing their balancing, tax loss harvesting, improving the overall tax efficiency of the portfolio. And last but not least, this environment, of course, is unique in a sense that we can take advantage of the higher yields in the bonds. So diversification, both within equity, but also using all the asset classes, including cash, including fixed income, and positioning portfolios for growth, not just in the short term, but in the long run, looking at the total picture and taking advantage of the current market environment the best that we can.
Katerina, thank you for the update. Katerina Simonetti there. On the outlook for next year, on the S&P 500, looking for 4,500 on the S&P, led, of course, by Mike Wilson over at Morgan Stanley. The S&P right now, 45.50, about 13 minutes into the session. Coming up on this program, Argentina's Milei touching down in Washington.
What does Argentina need? It needs confidence. More importantly than international market confidence, it needs confidence of the people.
Can Javier Milei deliver that confidence? That conversation up next.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, an interview with former CFTC Chairman Timothy Massad. That conversation at 2:45 p.m. Eastern, 7:45 p.m. in London. This is Bloomberg.
What does Argentina need? It needs confidence. More importantly than international market confidence, it needs confidence of the people. There are a lot of sort of amorphous measures behind the scenes that point to some pretty solid performance by Argentina. So I think he just has to make the most of it and provide a sense of stability and, predictability to the next step. So he's laid out a vision. Dollarization, the narrative around that might be the trickiest part of it.
Argentina President-elect Javier Milei heading to Washington to meet with U.S. officials. The agenda explaining his incoming administration's anti-establishment economic plans, including shutting the country's central bank and ditching the peso. While Milei has paused those plans for now, he emphasizes closing the central bank will be non-negotiable. Your team coverage starts right now with Bloomberg's Damien Sassa and Katie Greifeld with more. Damien, talk to us about what's on the agenda this week for Javier Milei.
Well, I think his choice of economic minister being Luis Caputo tells you everything you need to know. Caputo was there during the Macri administration. He succeeded Sturzenegger, who created a run on the banking system in Argentina. So, you know, he has a lot of familiarity with players at the IMF. We know there's a key issue there. And we're talking about a country, Jonathan, that has $450 billion of debt and really no plan ahead on how they're going to pay back their creditors. And so, you know, in order to avoid falling into arrears, they did make a $2.6 billion payment just back in October. But how they're going to continue to pay down that debt remains a big source of concern for creditors and for investors alike.
He says closing the central bank will be, quote, non-negotiable. Damien, you alluded to maybe a different speed. Is this a different speed on the same journey to the same destination, or a change in destination?
They have 1 trillion peso. I mean, you have to, there's a big debate on what the peso-dollar exchange rate is now, so I'll just leave it at that. 1 trillion peso in what they call LELIQ, short-term notes trading at about 133% per annum. I mean, 133% yield on these LELIQ notes, these short-term dated notes. There's $1 trillion of them outstanding. That's how the economy funds itself, Jonathan. You can't just break up the central bank with all this debt overhang. You know, you have to do it systematically over time. I applaud his efforts to try and dollarize the economy. It's going to be a difficult slog.
The market's in for another roller coaster. Katie, how's this market taking it?
Well, you take a look at emerging market. It has been a bumper month. Stocks, bonds, currencies, all heading to their best month since January in November. The MSCI Emerging Markets Equity Index is up 7.2% this month alone, erasing its 2023 losses. And there's a few different catalysts here. We'll get to Argentina, but front and center, you have building conviction that the Fed has reached the end of its tightening cycle, that its next move is likely going to be a cut. There's also easing tensions, or at least the appearance of them, between the U.S. and China after Joe Biden and Xi Jinping's face-to-face meeting earlier this month. And of course, as we heard from Damien, you do have the election of Javier Milei. That has been a boost as well. If you take a look at ARGT, that is the Global X MSCI Argentina ETF. It's absolutely skyrocketing so far in November. It is up 30% this month, despite Milei's unconventional economic plans, up 47% so far in 2023, so outperforming the rest of EM as well.
What do they use in EM, that word? What is it, Damien? Idiosyncratic.
Idiosyncratic,
is that
yeah.
the word? That's the word, right? Let's talk about China, something that's not idiosyncratic to EM. What's happening in China? Damien, what's the latest?
The latest is the industrial profitability numbers, only up 2.7% overnight. That's on a year-on-year basis compared to what we saw in September when it was 11.9% growth, and before that 17.8% growth. So, Jonathan, industrial profitability is declining in China, and this is obviously an impact of deflationary forces, which could spill over into the rest of the world. And so that is obviously capturing the attention of a lot of EM investors. Let's be clear, on a year-to-date basis, yes, EM equities are up something on the order of 2.5%, but EM currencies are up 3.5%, which means it's a currency story, Jonathan. It's not an equity story just yet.
Damien, just quickly, deflation out of China, good news or bad news for the rest of the world?
Well, it's good news if you're a central bank that's looking to cut to stimulate your economy. But if your economy is humming along just fine and you don't feel any need to cut, and you have inflation coming off, there's a bigger decision tree there. Let's just leave it at that.
Damien, thank you, sir, for the update alongside the brilliant Katie Greifeld. Thank you to you both. About 21 minutes into the session, equities pulling back about 1/3 of 1% on the S&P, down about 1/4 of 1% on the Nasdaq with some sector price action. Here's Abby.
It may be a modest, small decline for the S&P 500, but it is broad-based from a sector standpoint at this point, John. If we go into the Bloomberg terminal and use the IMAC function, energy is the worst sector, but you can see 9 out of the 11 sectors are lower. Not huge losses, though. That worst sector, energy, down in sympathy with oil, down about 0.8 of 1%. On the other hand, we do have real estate popping higher, up about 0.2 of 1% as yields are down a little bit. Those dividends look a little bit more attractive. And then consumer discretionary, a small bid on this Cyber Monday after that record Black Friday. Let's take a look at these two sectors. Consumer discretionary, which houses Amazon among other retail companies, and then the retail index, which also has some of the very much smaller retail companies, both hired the best month since June heading into this Cyber Monday. Will it make it even more? Well, we'll check in tomorrow, John.
That is ridiculous. Abby, thank you. Let's get up that chart once again. Just have a look at those numbers. Month to date, we're talking about some of these moves so far in the month of November. Jack Caffrey, JP Morgan, last week said, what a year November has been. Seriously, what a year November has been. That's 1 month, up by more than 12% on consumer discretionary. Thanks for that, Abby. Coming up on this program, we'll get you the calendar for the rest of this week. Your trading diary is up next.
We now have been able to get new categories in as a result of Marketplace, which is now online at both Bloomingdale's and in Macy's. So I bet on department stores. And obviously, I've made my career doing this. And it is it's still very, very relevant. We're going to be ready for where the customer is evolving. And we've got very strong assets to be able to do that, both on mall and obviously online.
The Macy's CEO speaking confidently about his business. That's probably what you'd expect. But the news we've had from the consumer over the last week, constructive. Jobless claims back down to about 209. We had some mixed guidance coming from the retailers. The latest numbers for Black Friday, though, pretty good so far for online. Your equity market so far into the session, about 26 minutes in, pulling back by about 0.25% on the S&P 500 on a 4-week winning streak. Let's see if we can make it week 5 through this week. That's the price section. Let's get to the trading diary. The week ahead looks like this. President Biden speaking at 2 p.m. Eastern. Tuesday, we'll get U.S. consumer confidence. Wednesday, U.S. GDP plus, earnings from Dollar Tree and Foot Locker. Thursday, another round of jobless claims and core PCE inflation numbers. And finally on Friday, rounding out the week really with the main event, it's Fed Chair Jay Powell speaking from Atlanta. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. I hope you all had a wonderful Thanksgiving here stateside. More still to come this week from New York. This is Bloomberg.